Hi, this is Joe. I'm going to discuss the key aspects to MACD divergence that you really need to learn before using this as a tactic. So watch this video if you want to learn some of the pitfalls to using MACD divergence that I see happen a lot out there. And then also I'm going to show you near the end, I'm going to show you some tactics, a specific MACD divergence signal that I would consider to be absolute gold. So first hit that like button, and I appreciate all your support, and let's get into the chart. So I'm actually going to start, I want to show you a specific example of why I think this is a difficult way to look at the market using MACD divergence. I see a lot of people out there that the moment, so first of all, this video sort of assumes that you understand the basics of MACD divergence. I've done a couple of videos on it already, so I don't want to get into like the calculation of MACD and what's causing the divergence and all that. I'm sort of assuming that you have an idea of what divergence is. I'm going to try and show you in this video, maybe go to the next level and say, okay, we're seeing divergence, but I'm losing money at it. And I think I'm going to show you a couple of the reasons why. So the first thing is, if you look at this chart of Proctor, notice how, we've made a higher high up to 100 in price. And if you look at the MACD, it's not confirming. So it's made a lower high at this point. Now, I mean, I've said this multiple times. Again, if you go back through old videos, but the fact of the matter is this is only the potential for divergence. This does not qualify as divergence. Simply having MACD not confirm the new high as price hits a new high is only a sign that there could be a problem. You always need price confirmation before considering doing this type of trade. But one of the I'm going to show you a couple other aspects that I think are fairly important to watch. So this is the first and most important thing, is just to understand that just because a price of a stock makes a new high, and whatever indicator you're using, I'm using MACD for this, but again, it can be used with any other momentum indicator you want to use. If it's not confirming right away, don't be under the assumption that this is a short sale at 98.48 because it's going to go down right away because the MACD did not confirm. So that's kind of the first factor. And I want you to remember this. So I've created this, I got this little cartoon, the Wile E. Coyote, he's my buddy. He's about to get run over by a train. And I want this to kind of be stuck in your mind, because if you take trades where you don't have confirmation in the MACD, you are going to get run over. And you're going to get run over all the time. And you're going to say, because MACD divergence is very specific. There's very specific aspects to it that you really need to follow. And most of the time when I see people out there saying there's divergence, it's really not divergence. So I just want to make sure I made this point really clear. Let's go and now look at a few aspects that I think I haven't talked about before in my videos, but I think are pretty important. So there's two things that I like to do when I'm looking at and focusing on divergence plays. So number one, if you look at this Facebook chart, notice how to the far left, I'm giving some different examples. So price comes down and it rallies up, and then it makes a new low in price. And if you look at what took place, the MACD lines rallied up, didn't get up to the zero line, but got pretty close, and then came down and made a significantly higher low, with price making a lower low. I think this qualifies as your standard divergence play. And the reason why I like it is because there's not a significant amount of difference between the two bottoms. And this can be true for peaks as well. You look at it in peaks and bottoms, but in this case, we got two bottoms and they're about a month apart. I think if you look at something and the difference, so if you're looking at a daily chart and there's just such a huge amount of time between the bottoms, then I think you have to be really careful about whether that's truly divergence or not. Now, I'm showing you actually a peak up here, and look at the difference between this peak, and then look at the difference in the MACD. So there is divergence here. What I don't like about this, and in this case, it actually did work. It was divergence, and it played in your favor if you would have traded it this way. But I wanted to point out that I'm not a huge fan if you look at what this was about 2 to 3 months, again, on a daily chart. So you're talking about a pretty significant time in between the peaks. Too much time, in my opinion, to really consider this as a divergent play. So there's signs of momentum loss here, but I don't necessarily consider this as a divergence play. And the reason is, again, because they're too far apart. There's a second aspect to this that I think is critical. So if you have a peak in price and you have a peak in MACD, and then you go through a corrective process in price, and the MACD lines either make it down and just sort of slightly break the zero line, or go through it like they did here and then turn back around. I personally look at it as a reset. I wouldn't view this as divergence. If you come down and break the zero line, I would no longer consider this as a divergent play. It doesn't mean that you can't show necessarily signs of momentum loss like it did here, but if I'm looking to play as a trading tactic, I really prefer to see the peaks cause the MACD to stay above the zero line. So I'm comparing 2 consecutive peaks above the zero line, preferably on a daily chart about a month apart. So we're talking about 20 or so bars. And so if I see that, I find those to be a little bit more enticing to me. Let's go to the third example on this chart. And if you notice, again, we make a lower low in price, and they're about a month apart. I mean, it was a little bit longer than a month, but not that bad, not that much more. And then again, you've got the MACD doing the exact opposite, making a higher bottom while price is making a lower low. So that, again, qualifies as your standard divergence play. I think the 2 main aspects I wanted to make sure you understand about it on this chart is you got to make sure the distance between the 2 peaks isn't too far away. And then the second thing that I think will help and improve your success with this as a trading tactic is try and find the trades where the MACD line stays on the same side of the zero line. So if it's on the short side, it stays below zero. And if it's on the long side, it stays above zero, at least in the area. I mean, you can come up to it, but if you really come roaring through it like this, I think you got to be careful there. So let's go and look at one other aspect that I think will really help dramatically. And that is, you know, the thing about this trade is I think a lot of people want to use it as a counter trend play. Everybody likes to buy something when it's really far down and try and be a hero and dive in there when it's really ugly, and I'm going to buy it at the low. And so, you know, one of the things to protect yourself against doing that, because if all the other time frames, if every single time frame is in a downtrend, except for and confirming the momentum to the downside, except for the time frame you're looking at, then you don't want to be doing that trade. It might, you know, I mean, I guess you could do it and just understand that it's probably more of a low probability and you got to play it really quick. I think the better way is to make sure you have MACD divergence on 2 back-to-back time frames. And so I'm going to start here with AT&T. I've got this on the left side. I've got the weekly chart, and if you notice, I've got 2 comparable bottoms, pretty good. Not too much of a distance between the 2. So it meets the criteria that I was talking about just before on the Facebook, where you rally up and you come down. So I've got this comparative low. And if you notice, the MACD is diverging on the weekly chart. Now, if we go to that same time period and on the last part of it, on the right side, I've got the MACD on the daily chart. And again, I'm showing a lower low on a daily compared, and it's only about a month apart. And then notice the MACD taking place or reversing on this time frame. So when I get divergence in this time frame and I have divergence on this time frame, so I've got 2 back-to-back divergence patterns taking place on the same stock at the same time. Now I want to be more aggressive. I'm willing to play this as a trade. I think this is a good pattern to play counter trend. But if I'm going to play counter trend, I want to see it in back-to-back time frames. We're going to switch to the charts now, and I'm going to show you. I've got my layout. It's a little bit different. I've got a chart of Google. I've got a monthly chart, bottom left. Bottom right is a weekly chart, and then top right is a daily. And I've got this vertical line showing the time frame. So this is the same point in time on all three of these charts. Okay. And so what I'm trying to show here is I have been talking about a specific trading pattern, a particular setup or strategy that can be used based on the moving averages, which is 18. So I'm starting with the high time frame on the monthly, and I'm talking about a monthly chart with a rising 18 and a rising 40, and the price pulls back into that zone. And it's still, you still have, 18 above the 40, both of them rising. Okay, so that's kind of your initial qualifier. And to do this type of divergence pattern, you actually need 3 time frames. So I'm going to show you exactly how I'm doing that. So we start, and again, the higher time frame is your pullback time frame, and then we go to the weekly chart. And if you notice what's taking place here, now we have the opposing trend where the 18 is below the 40 and price is also below both moving averages. So this is the qualifier. These two charts have now qualified for what I have talked about in my easy multiple time frame strategy video. Go back and look at that and review that. It's a very powerful signal. You don't even need to use this momentum indicator, momentum signal that I'm going to show you. In and by itself, just using the moving averages, it's a very helpful, very profitable signal. And I'm going to give you more detail on that. We've been doing some back testing on it, going back 10 years, and I'm going to give you the results of that in the coming weeks. But I want to make sure you understand we're starting with these 2 time frames, and I have the setup in place on the monthly and the weekly. Now I'm going to go to the daily, and let me just do this. I'm going to move this over, and I want to zoom in a little bit so you can see a little bit better. So this is the spot where the 18 crosses down below the 40 on the weekly. So it's right in this zone as the price is dropping down to new lows right here. And if you notice what's taking place, price is making lower lows, and the MACD is making higher lows. Now, again, so this is the same kind of counter trend divergence that I was talking about prior. So, this is exactly the type of setup that I'm talking about. The only difference is what I have in my favor right here is that I know I have the monthly chart in my favor. I've got a rising 18 month, rising 40 month, both lines rising. I've got the criteria in place for a buy signal, and now I can get in and get aboard very, very aggressively. And there's 3 different ways you could go about doing this. It's really purely up to you. Number 1, you could come in and just buy the moment this comes up through these bottoms. And let me just take this. So this horizontal line kind of coming back up through, as soon as it starts to come up through those lows, you buy and you put a stop at the lows. So that's your most aggressive approach. The second approach would be to wait for this big green bar to kind of complete and know that I've got real buying showing up. I got a big, strong green bar that proves there's buyers that are willing to step in. And then the third approach would be to wait for this to get back above the 18 on this daily chart. So those are kind of 3 different choices depending on what type of risk you'd really like to take in the trade. And I just wanted to point that out. But all 3 of those are considerably earlier than what your signal would be if you waited for the multiple time frame signal, which would be crossing back above the 40 on the weekly chart. So if I'm just using 2 time frames here and I'm only using the moving averages, I've got sort of a situation where I'm probably going to be taking a lot of risk. I'm probably going to be getting in a little late. I'm probably going to I have to put the stop way down at the bottom. So it just makes it a little bit more difficult. If I get in using this approach, we're talking about really getting in within a day or 2 right off the lows. And then we know we have the bigger picture in our favor. And you really can use this as an entry point in a long-term trend. Obviously, this is the monthly chart, and we've got a pullback on the monthly. So I'm showing you a tactic that can be used for long-term investments. But I also want to make sure you understand this can be used for short-term trading tactics, just making sure you have all three of these time frames kind of in your favor. Let's go and take a look at another example. So this is basically right around the same time. Stock comes in, pulls in. We've got a rising 18 and a rising 40 on the monthly chart. The weekly chart, again, 18 crosses down below the 40, price is below. The MACD lines are way down and kind of oversold almost. So I'm not really getting a signal in this particular instance on the middle time frame, the weekly time frame. But I can see that I have the potential for a buy signal. But again, in this situation, if I wanted to wait for my 2 time frame signal, I'd have to wait for it to come all the way back up through the 40. Now, if I go and look at the daily, again, we've got the same situation. Just to give you another example, you know, making lower peaks in price and higher peaks on a MACD basis. And so, again, we could be aggressive by taking a move back above this last bottom here. Or in this instance, actually, it's the same as the big green bar. Because if I zoom in a little bit, oops. Let me zoom in so you can see this a little better. Look at this big, huge buying bar right off the low. So again, this seems like a pretty aggressive play, right? But the difference is, so you're buying, let's say you at the completion of this green bar on the close of that day, and you're putting your stop in right underneath the low of the prior day. But look at what you have behind you. You have the actual support on the monthly chart. You've got the moving averages working in your favor. You know you're in a long-term uptrend. You're actually somewhat oversold on the weekly and sort of stretched away to the downside. And now you're kicking in a signal on the daily chart. So I think it's just really a good example of all 3 time frames kind of working together there. So I just wanted to emphasize, if you're going to use divergence, try and find it in the direction of the trend. And if you're going to do it counter trend, make sure you've got divergence in back-to-back time frames. Let's see some. I would like to see some comments. I want to get some feedback on some of the content I've been putting out there. This is, this is sort of high end. I think if you can understand this, it's going to have a pretty big impact on your trading. So let me know if this makes sense to you, and we'll talk to you soon.